Hello everyone. How do you identify outperforming stocks? Have you ever bought a stock was going to perform well, only to find yourself trapped after purchasing it? If you've ever been uncertain, this video is tailored for you. In this video, I'll share 3 strategies to help you identify outperforming stocks and the right time to buy them. Finally, I'll also share a practical tip for actual trading. Moving on to the main topic, let's first introduce a stock pattern often seen in outperforming stocks, a pattern I frequently use in my trades that has earned me a significant profit over time. This pattern is called the Volatility Contraction pattern, or VCP for short, which essentially represents a narrowing of price fluctuations. This concept was introduced by Mark Minervini, an American investment expert who has applied this pattern to his trading, achieving an annual compounded return of over 30% throughout his career. Next, we'll look into how to spot outperforming stocks and the VCP pattern. I always say that to learn something effectively, you must understand the underlying principles why it happens and why it's effective. Mastering the logic and principles behind it is the real skill. If you merely learn some rules and apply them without understanding, you'll only know what happens, not why it happens, leading to a superficial understanding, which isn't beneficial for developing your own trading system and investment style. I'll explain the key logic behind the VCP pattern. It's a concrete representation of a stock's supply and demand dynamics. Essentially, a stock rises because the demand to purchase it exceeds the supply to sell. If a stock is in long-term demand exceeding supply, its price will likely increase over time. Conversely, if the supply to sell exceeds the demand to buy, creating selling pressure, the stock will not rise and will fall until a new and significantly larger buying demand emerges. I'll use Costco as an example, which has also earned me a fair amount of money. When a stock rises sharply from $415 to $560, there are investors who bought at lower levels, wanting to profit at higher levels. These investors, possibly including funds, institutional investors, create selling pressure when they sell, leading to a price drop. This drop, in turn, attracts investors who were watching the stock during its rise but couldn't buy in time. They find the lower price more attractive, leading to a price rebound. Once the price rebounds to or nears its previous high, it provides a way out for investors who bought in late and are at a loss. Generally, people are reluctant to admit their mistakes and stop losses during a downturn, hoping the price will return to their buying point. Now, with the price nearing its previous high, it prompts them to sell their shares. Those who bought at lower levels also profit at this point, so some choose to sell, leading to another price drop. Thus, you'll see the price continues to fluctuate. This is irrelevant to us, as what we're waiting for is when the supply is exhausted and demand re-enters, exceeding current supply, causing the price to rise again. And VCP helps us identify this opportunity. Looking back at this example, the volatility throughout this year has been quite significant, and the trading volume has also been substantial, making this simply not a good moment to buy this stock. The optimal time to buy this stock is when its volatility decreases and trading volume diminishes. A reduction in trading volume indicates that there is little supply of the stock on the market, and the most capable investors are not willing to sell their shares. For instance, within this period of volatility, there was a moment when trading volume significantly decreased, leading to a very low volume of trades. This is a critical point because the volatility was below 7%, followed by a significant increase in trading volume. In simple terms, the supply of the stock suddenly decreased, while the demand for buying the stock significantly increased. Consequently, the stock price surged significantly after this contraction. Timing is everything. Identifying the right moment to buy or sell is a crucial factor in whether your investment in stocks will be profitable. As we observe the subsequent development the stock has already seen a substantial increase. Investors who bought in at lower levels have already gained over 15% profit, and those who bought in even lower have gained over 20% profit. Once they have the opportunity to cash in, the stock price will fall again. This is a characteristic of all stocks, including strong ones. However, the difference with strong stocks is that after they fall and undergo a medium-term adjustment, they continue to reach new highs. Take this case. It adjusted from July to October 2023. During the adjustment, there was a rebound, causing investors who were in a loss to concede and exit, and also triggering profit-taking exits by investors who bought at lower levels, leading to a price fall. It's important to note that at this point, the price did not fall below a previous bottom, and when it fell to this price, it fluctuated slightly for a month. Also, pay attention to the trading volume during this period, which was very small, indicating that supply was very limited, and that investors holding the stock did not sell their shares. In simple terms, the current holders of the stock are relatively strong investors. After this new round of contraction, the volatility continues to narrow before rising again. This is the message revealed by the volatility contraction pattern. There is hardly any supply of stock being sold. While the demand to buy is steadily increasing, it's very likely that this demand will continuously push the stock price higher. Let's zoom in a little bit. After two tight contractions and then a breakthrough at this point, the performance of this stock going forward is key. When buying the stock, the stop loss level should be set at $540, so the risk does not exceed 8%. Subsequently, the stock never fell to the stop loss price, and its increase reached 30%. Simply put, an 8% risk can exchange for an opportunity of more than 30% potential profit. Next, I will teach you 3 methods to accurately identify stocks that exhibit the VCP. The first technique involves ensuring that the stock is in an upward trend. Essentially, outperforming stocks typically form a significant upward trend. It is within these large upward trends that strong stocks continue to rise. An effective volatility contraction pattern VCP must also occur within an upward trend, not a downward trend, as the latter is likely to fail. How can you determine whether a stock is in an upward trend? You can watch this technical analysis video for a more in-depth tutorial. This can be discerned through the 50-day and 200-day moving averages. Moving averages smooth out stock price data to reveal the underlying trend and average price. The 50-day moving average represents the medium-term trend, while the 200-day moving average indicates the long-term trend. The second key point is that both the 50-day and 200-day moving averages are in an upward trend. The third point for identifying an effective VCP is to examine the 50-day and 200-day moving averages. If the current stock price is above the 50-day moving average and the 50-day moving average is above the 200-day moving average, with both moving averages trending upwards, then the stock is in an upward trend. If you find this tip helpful, remember to subscribe because I have many more stock trading tips to share with you. The second technique involves the first contraction in the volatility contraction pattern VCP needing to be within 50 to 60%, with the ideal situation being the first contraction within 20 to 35%. If the first contraction of a stock is 50 to 60%, then it's best for the bottom formation to take 6 months to a year. This allows enough time for the supply to stabilize. The reasoning behind this is that if a stock adjusts by as much as 50% and then quickly returns to its original point, consider that the stock has adjusted by 50%. If someone buys at this position and the stock returns close to its original price, and those who entered at the bottom have doubled their profit, which could trigger a large selling off due to substantial profits, such a pattern is likely to fail. In summary, the contractions in AVCP need to be narrowing continuously, with at least 2 contractions being sufficient Of course, some stocks may have 5 to 6 contractions, but generally, there are 3 to 4 contractions. It's also worth mentioning the logic behind VCP, which is to observe the relationship between supply and demand. Therefore, the concept of VCP, aside from being applicable to individual stocks, can also be applied to commodity markets or the foreign exchange market. The third technique requires that the last wave of contraction be within 10% during this last contraction period. The volume on down days is predominantly low, a phase we call the tight area. Your correct entry point is when the stock price breaks out of this tight area. The underlying reason is that we aim to enter with the lowest possible risk. The last contraction being within 10% and on low volume indicates a lack of significant supply. Once the stock price breaks through the critical point with accompanying volume, it indicates that supply has vanished and demand is substantial, potentially leading to a rapid price increase in a short time. Let's look at this example again. A stock that has just broken through the critical point not only did not fall through the tight area, but also increased by more than 30% within 6 months. This stock meets the first criterion, with its price above the 50-day moving average, the 50-day above the 200-day, and both moving averages trending upwards. The second point, its first contraction was 35%, the second 20%, and the third 12%, showing a continuous narrowing. Notice the details. During the last contraction, the volume on down days was low, but as it rose, the volume significantly increased. That's the ideal stock performance we want to see. Thirdly, the last contraction had only in 7% range, and the breakout was accompanied by above average volume, higher than the 20-day average volume, signifying that supply had essentially disappeared while demand remained strong. This led to the stock rising by more than 30% within 6 months and over 45% within 9 months. If the 3 methods mentioned above help you, please remember to like this video to support me. Finally, I'll share a practical tip. Regardless of how good a stock's pattern may look, there's no guarantee it will always rise. The aim of capturing VCP is to increase the chances of finding strong stocks with potential for rapid growth. An important note is that stocks fitting the volatility contraction pattern VCP offer no guarantee of a price increase, typically boasting only a success rate of about 50 to 60%. From my personal experience, because I strictly control losses and adhere to the third technique of selecting stocks with very narrow last contractions, my average loss has been kept within 5 to 8%, with average gains of about 10 to 15%. Thus, by winning more and losing less, it's still possible to maintain an ideal investment return. So, the last tip is to strictly control your losses and manage risk effectively. That's all for today's share. If you want to continue receiving my money-making methods in stocks and investments, remember to subscribe to this channel. If this video has helped you, give it a like. I hope my videos can help enhance your investment returns. See you next time.